Welcome to Sophie Daddy's channel. You know, when we think about what drives financial markets, we talk about earnings, interest rates, all that stuff. But today, we're diving into something much more primal, something that's at the core of human nature: fear. We're going to break down something called the Volatility Risk Premium. You can just think of it as the market's fear premium.
Okay, so let me start by asking you a question. Just a gut check. How likely do you think a catastrophic market crash is, say, in the next 6 months? What percentage comes to mind? 10%? 20%? Just lock in a number in your head.
So here's where it gets really interesting. For decades, the Yale U.S. Crash Confidence Survey has been asking that exact question, and what they found is that investors, both regular people and the pros, consistently say there's a more than 10% chance of a crash. But if you look at what's actually happened throughout history, the real probability is way, way lower, closer to just 1%. And this huge gap between what we fear and what actually happens, well, that fear gap is the engine that drives everything we're about to talk about.
Right. So if investors are walking around this worried all the time, what can they actually do about it? Well, it turns out there's a tool for that. A financial tool that works almost exactly like buying an insurance policy for your portfolio. It's how people buy themselves a little peace of mind.
Let's break down how that works with a super simple example. Let's say you own a stock that's trading at $105. You like the stock, but you're getting nervous about a big drop. So what do? You buy a put option. That's your insurance policy. You pay a small premium, let's say $2, for the right to sell your stock for $100 no matter how low it goes. Now, if the market's calm and the stock stays above 100, well, your insurance expires. You're out the $2, and whoever sold you that policy gets to keep it. Easy money for them. But if the market totally tanks and your stock plummets to $90, that policy kicks in. It pays you $10, basically shielding you from that disaster. See? You've just paid for protection.
Okay, so we know what this insurance does. But the really critical thing here is to understand what it costs and why that cost is almost always a little bit inflated. And that brings us right to the heart of the volatility premium.
The price of that financial insurance policy? It's set by something called implied volatility. The easiest way to think about this is that it's the market's collective guess about how bumpy the road ahead is going to be. And because of that big fear gap we just talked about, this guess is usually pretty pessimistic. It's the market's fear gauge, and it dictates the price of protection.
And then, on the other side of the coin, you have realized volatility. Now, this isn't a guess. This is what actually happened. It's the real turbulence the market went through, something we can only measure by looking in the rearview mirror. In our insurance analogy, this is the real cost of the actual damage that occurred.
And this right here, this is the whole game. Because our collective fear of what might happen, the implied volatility, is consistently higher than what does happen, the realized volatility. It means the price of insurance is systematically, consistently more expensive than the claims that get paid out over time. We are constantly overpaying for protection because we're always bracing for a bigger storm than the one that usually hits.
So just how consistent is this overpayment? Well, get this. The data shows that the premium, that gap between implied and realized volatility, has been positive about 85% of the time. Think about that. For the huge majority of the time, the people selling the insurance have been collecting way more in premiums than they've had to pay out.
This creates a very, very tempting strategy for anyone willing to be on the other side of that trade, for the people willing to sell that fear. There's a famous analogy for this strategy, and we're going to start with the good part.
The first part of the saying is picking up pennies. The idea is that you can just systematically sell these overpriced insurance policies, these options, month after month. And since you're right about 85% of the time, it just feels like you're walking along, bending over, and just picking up free money off the ground.
And boy, does the historical data make this look good. This chart looks at risk-adjusted returns, basically how much bang you get for your risk buck. Just holding the S&P 500 got you a Sharpe ratio of 0.32. But a strategy of systematically selling puts, selling that insurance, delivered a Sharpe ratio of 0.68. I mean, that's more than double. It looks like a total home run. But this is only half the story.
Which brings us to the other much, much darker side of this analogy. This is the part that explains why everyone isn't doing this all the time. This is the catch, and it's a big one.
The full saying is picking up pennies in front of a steamroller. Because while you're busy collecting all those nice little gains, you are unknowingly standing in the path of a rare but absolutely catastrophic event. A single, massive loss that can wipe out months or even years of your profits in an instant. This table just lays it all out so clearly.
In a normal market, which is about 85% of the time, you're the insurance seller. You collect your little premium. You pick up your penny. But in that other 15% of the time, when things go haywire, you are on the hook to pay out a massive claim. That is the steamroller. You win often, but small. You lose rarely, but you can lose huge.
But here is a really critical point that a lot of people miss. The steamroller isn't just a market crash. Look at March 2000. The S&P 500 had a fantastic month. It was up almost 10%. But the option selling strategy got absolutely smoked, losing 4%. Why? Because you're not betting against the market going down. You're betting against volatility. You're betting against big, sharp moves in either direction. A sudden rally can be just as painful as a sudden crash. The steamroller hits whenever reality is way more volatile than the fear that was priced in.
So let's bring it all home. Let's tie this all together. What is the volatility risk premium at its core? It's not free money. It's not a market glitch. It's a payment for a very specific and very scary job.
So here it is in a nutshell. The VRP is that insurance premium that nervous investors are happy to pay. It exists because of that gap between our fears and reality. Selling this insurance looks great most of the time, but you've always got that rare but devastating steamroller risk hanging over your head. So at the end of the day, the volatility risk premium is simply the market's paycheck to the person who is willing to stand there and take that risk. The VRP really is the price the market is willing to pay for peace of mind. On one side, you have the buyers, who are desperately looking for shelter from their fears. And on the other, you have the sellers who are earning a premium for providing it. And that leaves us with the big question. Who is willing to be the one selling that peace of mind? And what's their price?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.